In this explainer, we're going to break down a fundamental economic force that, whether we notice it or not, quietly shapes all of our financial lives. And that force is inflation. We'll look at what it is, what causes it, and most importantly, how it directly impacts you.
So here's how we'll tackle this. First, we'll start with that familiar feeling of your money not going as far as it used to. Then, we'll get into a formal definition of inflation, explore its root causes, and see how it's actually measured. After that, we'll connect it all back to your personal finances and wrap up by looking at the tricky balancing act of trying to control it. All right, let's start with something I think we can all relate to. Before we get into any of the heavy economic theory, let's ground this whole discussion in a simple, everyday observation about money. I mean, you've probably asked yourself this question, right? That feeling that your budget just doesn't stretch as far as it did last year? Well, that's not just in your head. It's actually the most real and tangible effect of inflation at work in the economy. This simple example really gets to the heart of it. Think about it. If a dollar bought you a loaf of bread last year, but now you need $1.10 for that exact same loaf, the bread hasn't changed. What's changed is the value of your dollar. It has decreased. And that right there is the essence of inflation. Each dollar, it just buys a little bit less than it used to. Okay, so we've seen the effect. Now let's look at the cause. It's time to put a formal name and definition to this economic force we're talking about. Now, what's really important to understand is that inflation isn't just about the price of one thing, like gas or milk, going up. By definition, it has to be a broad and sustained increase in prices across the entire economy. And as that general price level rises, the purchasing power of every single dollar you have goes down. So that naturally leads to the next big question. Why does this happen? What actually causes inflation? Well, economists have pinpointed three main drivers.
The first one is called demand pull inflation. You can think of it like this. It's what happens when everyone wants to buy stuff, but there isn't enough stuff to go around. Demand is outpacing supply. In simple terms, it's too much money chasing too few goods. And when that happens, sellers can and do raise their prices.
All right, the second driver is called cost push inflation. This one comes from the supply side of the equation. It happens when the basic costs of making things go up. Things like raw materials, energy, or even labor. And when it costs businesses more to produce their goods, they often pass those extra costs on to us, the consumers, by raising prices to protect their own profits.
And the third cause is a bit different. It's called built-in inflation, and it's all about psychology and expectations. Basically, it's a self-fulfilling prophecy. When people expect prices to go up in the future, they change their behavior today, like asking for higher wages. And that very behavior can actually cause the inflation they were expecting. And this often turns into what's called a wage price cycle. Here's how it works. It starts with prices going up for whatever reason. So workers, seeing that their money doesn't buy as much, demand higher wages to keep up. Now, to cover those higher wage costs, companies raise their prices. And what does that do? It leads workers to ask for yet another raise. And you can see how this spiral just keeps going. So we've got these different causes of inflation. But that begs the question, how do we actually measure it? How do we put a number on it? Well, let's take a look at the official tools economists use. The main tool they use is something you've probably heard of, the Consumer Price Index, or CPI for short. This is the most common way to measure inflation, and its job is to track the average change over time in the prices that people in cities pay for a whole range of goods and services. So how does it do that? Well, the CPI tracks the price of what's called a basket of goods. Now, it's not a real basket, of course. It's just a big list of items that represents what a typical family buys. We're talking everything from food and housing to transportation and healthcare. It's meant to give us a broad snapshot of the overall cost of living. So when you hear on the news that the annual inflation rate is, say, 3%, what that really means is that the price of that entire basket of goods has gone up by an average of 3% compared to the year before. Okay, that's enough of the high-level economics for a moment. Let's bring this all down to a personal level. We've defined inflation, and we've seen how it's measured. But what does it actually mean for your wallet? The thing is, inflation doesn't affect all parts of your financial life in the same way. Take your savings, for example. If the interest you're earning is less than the rate of inflation, your money is actually losing purchasing power while it sits there. And what about your paycheck? If you get a 2% raise, but inflation is at 3%, you've technically taken a pay cut in terms of what you can actually buy.
But here's an interesting twist. If you have a fixed rate loan, like a mortgage, inflation can actually work in your favor. You end up repaying that debt with money that's worth less than it was when you first borrowed it. And all of this brings us to a really crucial final point. The goal isn't to get rid of inflation completely. In fact, managing it is an incredibly complex balancing act. You see, policymakers are trying to steer the economy between two very dangerous cliffs. On one side, you have high inflation, which is just destructive. It chews away at savings and creates all sorts of uncertainty. But on the other side, you have its opposite, deflation, where prices are actually falling. And that sounds good, but it's incredibly dangerous because it makes people stop spending, which can grind the entire economy to a halt. And this might be the most surprising takeaway of all. A little bit of inflation, a low, stable, and predictable amount, is actually considered a good thing. It's a sign of a healthy economy because it encourages all of us to spend and invest our money rather than just hoarding it. And that's what keeps the whole economic engine humming along. And that's exactly why the major central banks, like the Federal Reserve here in the US or the European Central Bank, don't actually aim for zero inflation. Their goal is stability. They use all the tools at their disposal, like changing interest rates, to try and hit a target inflation rate, which is usually right around 2% a year. And so we're left with this big ongoing question. Inflation isn't just some static number. It's a dynamic force that's always changing. And the real challenge, both for the people making policy and for all of us trying to understand it, is figuring out how to strike that perfect, ever-shifting balance between growth and stability.